Okay, dear listeners, Assalamu alaikum and good evening to everyone. Let's start the discussion of pre-seen FM mock section A. Today we'll be discussing and June 25. And I strongly believe you people have seen all the lectures, regular as well as practice videos. Okay. And I'm very happy from your WhatsApp group because your WhatsApp group is very alive. I think more than other papers which I have seen, which is a very good thing. And I'm more happy that majority of the queries are being answered by other students and they are correct also. So that's very nice. Okay, let's start. Statement 1. The fundamental principle of financial management for profit company. For profit companies, maximizing of shareholders' wealth, very true. Of course. Accounting, according to the value for money approach, effectiveness refers to minimizing the cost of inputs for achieving the targeted level of output. No. Basically, if effectiveness means I need the desired result. In order to get the desired results, basically that thing will be expensive, that will not be cheap. What examiner has written here, that effectiveness refer to minimizing the cost. That is not effectiveness, that is economy. So basically that is false. So one is true, the second is false. So option 3. Which two of the following are the part of fiscal policy of government? Which two of the following are the part of the, basically when we say fiscal policy, then you should be thinking for the taxation, government spending. When we say monetary policy, it relates to the interest rate, money supply. Which two of the following are the part of the fiscal policy of government? Regulation of interest, that is monetary policy, is not a fiscal policy. Government borrowing decision, that is fiscal policy. Taxation, definitely fiscal policy. Controlling monetary supply in the country, that is your monetary policy. It's not a fiscal policy. Which two of the following are the part of fiscal policy of a government? 2 and 3. Okay. Classify the following money market instrument based on their characteristics. You just need to match. Let's see. Repo agreement. Now, what is repo agreement? There are a number of examples. Assuming. Repo agreement means basically I'm selling something and then I'm going to repurchase that from you at a higher price. Repo agreement means there's no voice. There's no voice. Oh. Okay, what is repo agreement, repurchase agreement? For example, I am having a piece of land. Let's say I'm having a piece of land. Okay. I'm selling it for $100,000. That's very expensive. Okay, just assume. I'm selling it for $100,000, but with that, I'm making an agreement that let's say after 1 year, after 6 months, I will buy back this land from you at 1 lakh plus 10%. 100,000 plus 10%. That is repo agreement, repurchase agreement. That first I'm selling something, then after XYZ time period, I will get it back at a price which I have taken from you right now, plus I'll pay you the simply interest as well. So basically that land is just working as a collateral. That is simply a repo agreement, repurchase agreement. For example, assuming Bank A is giving bond to Bank B, but Bank A is saying, give me $100,000, take my bond, but after 6 months, I will give your 100,000 back with 10% interest, with 5% interest. If these kind of things, they fall in repurchase agreement. That is repo agreement. In repo agreement, now there are three types. We have to, repo agreement is a derivative. No, it's not a derivative at all. Discount instrument is not discount at all, because try to understand, I'm technically I'm taking a loan of 1 lakh and I'll repay you more than that. So basically, repo agreement matches with the coupon bearing instrument. But here, technically, I'm not paying interest semi-annually to you. Normally, what happens when I'm going to repurchase, I'll repurchase at a higher price. Someone is using the different instrument of Zoom. I have already mentioned, please don't do that. So basically, I'm not paying that semi-annually coupon rate, but I'm repurchasing at a higher rate, higher price. So that is repo agreement matches with a coupon bearing. Forward rate agreement is, students, who knows better than you, that is derivative. Forward rate agreement is derivatives. We are left with treasury bills, government bonds, discount instruments. Normally treasury bills, you will get them at a price even lower than the face value. So repo agreement goes with coupon bearing instrument. Forward rate agreement, definitely derivatives. You should not be making mistake in that. So treasury bill, discount instrument. Okay, now calculate the expected total shareholders return. Students, when we say total shareholders return, so in total shareholders returns, actually there are two things. One is the dividend and the second is the capital gain. Total shareholders return. For example, we are calculating total shareholders return, assuming in 2025, I'm just assuming, okay? Then I need to know the dividend of 25 plus capital gain of 25, but I will take the share price at the start of 25 or end of 2024. So actually, when I'm calculating the total shareholders return for in 2025, so logically, how will you apply that formula? That is very important. I need to know the share price at the start of 2025. Then I need to know what is the dividend at the end of 25 and what is the expected capital gain at the end of 25. Or there's a possibility that examiner might give me the price at the end of December 24. But basically, for in shareholders return, I need to have two things. One is the dividend, expected dividend, and another is capital gain. Share price, either examiner give you the share price at the end of the previous year or at the start of same year. Let's see what examiner has given us here. The dividend yield on the shares of Astute company for the year ended December X3 was 4%. Dividend yield is 4%. Okay. The EPS for the year was 140 cents. It makes, you should read the data properly. It is 140 cents. It means $1.4. And P ratio was 6 for there. The EPS expected to grow by 15%. And Astute company expect to increase the dividend payout by 10% over the last year. There's no change no change expected in P ratio. Now, P ratio is equal to current share price upon EPS. Examiner has given us the P ratio of previous year, which is 6 times. EPS of previous year is 1.4. So very easily I can calculate the share price of previous year. 6 multiplied by 1.4. I'm getting P naught 8.4. I'm getting P naught 8.4. Okay. Now I can calculate the dividend of previous year. Dividend yield examiner has given me 4%. So dividend P naught into yield will give me the dividend per share. But again, this is the dividend of the last year. 8.4 into 0.4. I'm getting 0.336. Okay, come back. Whatever we have calculated the values of December X3. We need shareholders return. We need expected shareholders return for 2004. We need total shareholders return for 2004. Okay, no issue at all. At least we have got one thing, share price, which is 8.4. Now I need the expected dividend in X4 and what will be the expected capital gain in X4. Okay, now read the question. The EPS is expected to grow by 15% and astute company expects to increase dividend payout will increase by 10%. Now look at this. Expected dividend will increase by 10%. 0.336 into 1.1. I'm getting 0.3696. I can easily calculate expected EPS. X3 EPS is 1.4. It will increase by 15%. I'm getting 1.61. Okay. The formula of P ratio is equal to P naught upon EPS. It is mentioned in the question that P ratio will not change. So P ratio will remain 6 times. Now expected EPS will be 1.61. I can calculate expected share price. That will be in 2000 x4. 6 multiplied by 1.61. You just need to multiply both of these. You will get expected P naught in X4, 9.66. Now I can very easily calculate the capital gain. This is expected in X4. P naught of X3 we already have, 8.4. The difference between the two share prices is your expected capital gain. 9.66 minus 8.4. I'm getting the capital gain 1.26. So expected dividend will be 0.3696 and capital gain 1.26 in 200. Let's see. 0.3696 plus 1.26 divided by 8.4 into 100. Students, I'm getting 19.4%. How did I calculate this? Let me repeat again. First, you need to know the formula of total shareholders return. Total shareholders return will have two elements. One is expected dividend plus expected capital gain. Capital gain is simply the difference between two share prices. The share price which we are expecting, that is going to be in X4, and in X3 we know the share price. Difference between X4 and X3 share price gives you the expected capital gain. So that is your total shareholders return. I strongly believe the entire calculation is clear to everyone. This is from where actually we start also our FM. In a very first lecture, normally we discuss this shareholders return. Now come here. Which of the following correctly represents a conservative working capital financing policy? In conservative working capital financing policy, we get our focus, more focus will be on long term. Conservative working capital financing policy. Holding a high level of current assets to minimize the risk of lack of liquidity. Actually, this is not a financing policy. You're talking about investment policy. Examiner is not asking us the investment policy. Examiner is asking us the conservative financing policy, not conservative investment policy. Using long-term sources of finance to fund current assets. That is true. Basically, conservative working capital financing policies means my focus will be on long-term source of finance to simply finance my working capital needs. So using long-term sources of finance to fund current assets. Let's see. Using long-term source to finance permanent working capital and short-term finance for fluctuating. If you read it nicely, that is a matching policy. It's not conservative. That is your matching policy, where we match source of finance with the nature of working capital. Long term for permanent working capital, short term for fluctuating. That is matching policy. It is not conservative. Using bank OD to finance entire working capital. Can I say this is aggressive? This is aggressive financing policy. It is not conservative. So the true answer is beta. Okay. Match the following types of commercial financing methods with their equivalent Islamic financing methods. Student, you should not be having any issue at all in this. Like equity finance, simply mudaraba. During my lectures, I've given these examples many times. That is mudaraba. Debt finance, sukuk. Sukuk is your Islamic bond. Venture capital, musharaka. Venture capital, musharaka. Trade credit is simply mudaraba. The trade credit is murabaha. Okay. Under which of the following circumstances the use of existing weighted average cost of capital may not be appropriate for carrying out investment appraisal? Under which of the following circumstances the use of existing weighted average cost of capital may not be appropriate? Let's see. The size of the new project is small in relation to the existing business of the entity. Here it is okay. You can use it. Existing WACC you can use here. In first, that is okay. The project would mean that entity would embark on a new business. That is diversification. You cannot use existing WACC. Diversification, you cannot use your existing WACC. In case of diversification, what happens? Your business risk changes. And when your business risk changes, you cannot use existing cost of capital. There won't be any change in existing WACC. If there's no change in the capital structure, no change in financial risk, you can use existing WACC. The operating risk of the new project is not different. If your operating risk of the new project is not different from the existing one, you can again use the existing WACC. Beta is the right answer. You cannot use existing WACC because in point number 2, what is happening? That is representing the diversification. In case of diversification, business risk changes. So we cannot use our existing cost of capital. Which of the following scenarios would evidence a semi-strong firm market? Semi-strong. The asset prices reflect all past market data. Can I say that represents the weak form? Number 1 is false. It actually represents the weak form. The asset prices reflects all information, public and private. Can I say that is false? It is actually representing the strong firm efficiency. Point number 2, it is actually representing the strong firm efficiency. Investors cannot consistently achieve above average return by analyzing publicly available information, as asset prices reflects all such information. That is true. Basically, in semi-strong form, what happens? Your share price reflects the information of the past plus the information which has been made public. Read it again. Investor cannot consistently achieve above average returns by analyzing publicly available information, and as asset prices reflects all such information. The assets are fairly priced, even including secret information. Can I say false? Point number 4 is also hinting towards a strong firm efficiency. An examiner has not asked us the strong firm. Examiner has asked us the semi-strong market. Student, I hope everyone knows that. If you directly don't know the answer, then another way of answering such question is choice elimination. But while eliminating the wrong choices, do not eliminate the true choice. And then you are finding the answer within the remaining choices. Okay, let's see. What is the equivalent annual cost for 2-year replacement cycle? Assuming that cost of capital is 10% to the nearest dollar. And what the examiner says, enter a positive amount. Please read the questions properly. There's no need to put a negative sign here. Even we know that when we calculate annual equivalent value, it comes in negative. But examiner has categorically mentioned that please enter a positive value, whatever your answer comes. Okay. And you just need to calculate annual equivalent cost for the second year. First lease company leases cars to various corporate users to be used for their employees. The cars are of the same specification. The company spends regularly on maintenance and other recurring costs. First lease wants to optimize the car replacement policy to ensure that the lessee companies are provided with the best possible options. Okay. Various scenarios are developed as follows. Cost of the car is 25,000. Maintenance in year 1 it is 5. In year 2 is 6,500. Trade-in value. Year 1 is this. Year 2 is, so year 2 value is important. Relevant present value factors they have given us. Okay. So we just need to calculate second year replacement cycle. So it's very easy. T0, T1, T2. 25,000. In T1 you have to bear the maintenance cost 5,000. Now in T2 there's a maintenance cost of 6,500, but there's a resale value 12,000. So in T2 there will be net inflow 5,500. In T2 two events will happen. One is I have to bear the maintenance cost 6,500. Second, the resale value. Discount factor they have given us 0 is always 1.909. 0.826. 25,000. 4545. 5,500 into 0.826. 5,500 into 0.826. Any answer? How did we get this? Please. In the second year, you have to bear the maintenance cost. We have to bear the maintenance cost 6,500 and the resale value is 12,000. This is how we got 5,500. So 4543. 25,000 plus 4545, 4543. I'm getting 25002. Annual equivalent cost. Now there's no need to write negative, just write this. divided by annuity factor of 2 years. Just add both of these discount factors. Because we are calculating annual equivalent cost for the second year replacement cycle. So 0.909 plus 0.826. Let's see, what are we getting? Even you're writing here negative, I'm getting 14410. But please, when you are entering this value here, you have to write positive. Any answer? Okay, you have to write positive, enter a positive amount. 14,410. Okay. What will be the operational gearing of Alex company up to 2 decimal points? Variable cost of a toy battery produced by Alex is 60, variable cost. Operating profit means PBID is 15% of the selling price. Operational gearing. Simply contribution upon PBID. Selling price is 100, variable cost is 60. So the contribution is 40. If you take 15% of 100, because selling price is 100, so PBID will be 15. 40 divided by 15, I'm getting 2.666667, so make it 2.67. The answer is 2.67 times. 2.67 times. Okay. What is the X dividend market price of Epsilon company share? The dividend paid by Epsilon company for the year X0 was 30 cents. Then X1, X2, and then X3. 35 cents. Total time period is 4 years, okay? Epsilon is likely to maintain the same growth in the dividend payout ratio. Growth rate, on average, it will be same. Cost of equity, K is 11%. The growth rate should be rounded off to 1 decimal point. Okay, should be rounded off to 1 decimal point. What is the X dividend market price? Now listen, the formula is P naught is equal to D naught 1 plus G upon KE minus G. This is the formula which you have to use. Examiner has given us the D naught, which is 35 cents. KE is given. We just need to calculate the growth rate. Total time period is 4 years. How will you calculate the growth rate? Last dividend divided by the first dividend. If data examiner has given you the 4-year data, you will take the power 1 upon 3. If examiner gives you the data of 5 year, then you will take power 1 upon 4. We have discussed this thing many times in our regular lectures. 35 divided by 30. Then 1 upon 3 means your power will be, let me do that for you also. This will be, power will be basically 0.333. Okay. Whatever comes minus 1, then into 100. Basically, I'm getting 5.267%, but examiner has mentioned something. The growth rate should be rounded off to 1 decimal. So instead of this, we'll take 5.3%. Mathematically, it should become 5.3. So simply P naught is equal to, and please look at this also. All the options are in dollars. Dividend examiner has given us in cents, but we need the P naught in dollars, not in cents. What I'm writing, $0.35. Now I'm not writing the data in cents. $0.35 into 1.053. K is 11% minus 0.053. So in the denominator, 0.11 minus 0.053, you will have 0.057. 0.35 into 1.053, I'm getting 0.36855. Let's see what is the final answer. Student, I'm getting the final answer 6.4657. If you do not get the exact answer, choose the nearest one. Delta. What would be the maximum NPV that FTSE could achieve by optimizing its investment within the limit? They have got limited capital 550, which is hinting towards capital resting. Okay. FTSE has 5 possible capital investment for which its financial details are given. Project, let's say we have got A, B, E, M, N, Q. Okay. The company has access only 5,50,000 for capital expenditure currently. Project A and B are mutually exclusive. Student, recall the concept mutually exclusive means rule of OR. Rule of OR, it means I can opt any one of them. If A comes, B cannot come in that project mix. If B comes, A cannot come because they both are mutually exclusive. Rule of OR. All the projects are divisible. Now listen carefully. All the projects are divisible. What I'm going to do, I'll be using the profitability index number 1. Number 2, from A and B, the project which has the highest profitability index, simply I will opt that project and rest of the projects. How will you decide from A and B? The project which gives you higher profitability index. Just opt that and ignore the other project. And look at this EN project. It's a loss-making project, so obviously I will not consider this. Now simply let's calculate a profitability index. I'm calculating here. Simply NPV divided by investment. 6,500 divided by 2,50,000. I'm getting 0.026 for A. 6,000 divided by 1,60,000. I'm getting, for B, I'm getting 0.0375 B. So student, which one will you go with? A or B? Because A and B both are mutually exclusive, we can only opt one of them. Can I say the rest of the project and the entire project mix I will make with project B? I'm not going to consider project A because project A's profitability index is lower than the B. Okay. Now 3,500 divided by 1,75,000. Oh, 3,500 divided by 1,75,000. Student, I'm getting 0 point this one. That is EM. Okay. Leave this. The last one, Q. 1,575 divided by 108. Just very simple. Projects, investment, NPV. Of course, we'll start with B, leave the first one. How much will be investing? 1,60,000. And your NPV will be 6,000. After that, I'll go for EM because EM profitability index is more than, can I say 0.02 is more than the 0.0145. So let's go for EM. We'll be investing 1,75,000. We'll get NPV 3,500. Now, the total investment which we have 5,50,000. We have invested 160. We have invested 175 also. How much is still left? How many dollars are left? 550 minus 160 minus 175. 5,50,000 minus 160 minus 175. We still have 2,15,000. And can I say the last project is Q, which needs only investment of 108. And NPV will be 15. Even without using the entire funds, the maximum NPV which can be generated is 11,075. 1,60,000 plus 175 plus 108. This is the amount which we have actually used. Why we are not going with A? Because project A and B both are mutually exclusive. Rule of OR will apply and we will opt the project which has a higher profitability index. B is having a higher profitability index. That is why we made the entire project mix with B. After that, EM project profitability index is higher than the Q1. That is why EM got a second number. Q is the third number. And why we left EN? EN is a loss-making project. That is why I'm not putting my money over here, even though we do have the funds. But it does not mean if you have the funds, make investment in a loss-making project. Never. So the maximum possible NPV is 11,075. Now come here. Okay, let's see. For each company, select what the impact would be on the date of payment, assuming that none of them plan to hedge the current, they don't want to go for hedging. Wow, great. Let me tell you, if you're not going for hedging, fine, you need to know one thing. If due to import, you need to pay in foreign exchange in the future, let's say you have import the goods today, you will be making payment after 2 months or 3 months. Always remember one point. If your currency is getting depreciated, then on import, you will always have a loss. If my currency is getting depreciated, it means I'll be paying more. For example, I have bought the goods for $5,000 today, but I have not made the payment. I'll make the payment after 6 months. But I know that my currency is depreciating every day. If my currency is depreciating every day, when the time comes, I'll be paying more than what I would have paid today. So whenever your currency gets depreciating, then on import, you will be having a loss. But if there is an export and your currency gets depreciated, then you will be having a benefit. How? For example, if I have made an export today, but I'll be receiving the foreign exchange after 3 months. And I know that my currency every day is getting depreciated. Then obviously when in 3 months time, 4 months time, when I'm going to get the foreign exchange, when I'll convert that foreign exchange into my local currency, I'll be getting the more amount. So a very simple rule is, if your currency is getting depreciated on export, you will be having a benefit. In fact, if your currency is depreciating, that depreciation of the currency encourages export, but depreciation of the currency actually discourages import. So export is encouraged if your currency is depreciating, but import is discourage. Let's see what is happening here. And they are not going for hedging, okay, both of them. Oriental company, a company based in Singapore, has dispatched goods worth, look at this, Singaporean dollar 1.5. It's not dollar 1. It is Singaporean dollar. Now listen carefully to its US customer H company. Now stop. Read the question properly. Oriental company, a company based in Singapore, has dispatched goods. Okay. In Singaporean dollar 1.5 million to its US customers. H company, the payment is due in 120 days. The Singaporean dollar is expected to strengthen in 4 months' time against the US dollar. We are, for example, we are an Oriental company and we have dispatched the goods. And look at the invoice. The invoice is Singaporean dollar 1.5 million. Now listen. Oriental company will be paid in Singaporean dollar. Now, no matter dollar is getting stronger or weaker, Oriental company will have no issue at all. Why? Because the invoice is in Singaporean dollar. Like ACCA gets their fee in pound sterling. Now, no matter pound sterling is getting stronger against any other currency or weaker against any other currency, they have no issue at all as far as exchange rate is concerned, because their invoices are generated in pound sterling. The same thing is happening here. Oriental company will have no effect. Now Oriental company will be getting their money in Singaporean dollars. But who has to buy the Singaporean dollars? The customer Edge company. The payment isn't due, okay? The Singaporean dollar is expected to be strengthened in 4 months' time against the US dollar. Now listen, it means US dollar is going to get weaker in 4 months' time. You have import the goods, you will be making payments in 4 months' time, and your currency is getting weaker. Because if Singaporean currency is getting stronger, it means US dollar is getting weaker. So on import, H customer will be having a loss, because your currency is getting weaker. What is the expected market value of the bond to the nearest? Mallet company had issued $100 redeemable bond some year ago on which interest rate is 7% payable. The interest for the current year has just been paid. These bonds are due for redemption in 2 years' time at a premium of 10% on the nominal value. Investor in similar bond required a yield 10%. This 10% will work as a discount factor for you. The discount factor are as 7 coupon rate we don't take as a discount factor. The required yield is your discount factor. So very easily we can calculate the market value. T1, T2. Because now only 2 years are left till maturity. Cash flows. Par value into 7% is 7. In the second year, keep watching. It will be 7 plus 110. How did I get this 110? Redemption is at 10% premium. It means in the second year, the total amount will be 117. Discount factor 0.909, 0.826. You just need to calculate present values. Some of the present values will give you the market value of the bond. 117 into 0.826. Let's see what are we getting. We are getting 104.823. Whenever we are not getting the exact answer, then always go to the nearest one. So which one we are going to choose? Yes or no? Please reply. Maybe let me. Oh, here I made a mistake. 7 multiplied by 0.909. It is actually 6.363. So we are getting exactly 103. So all you need is just simply calculate the present value of future cash flows. Breakdown of 117 is very okay. In second year, there will be a normal interest 7 plus principal amount 100 plus 10% premium. In 2 years' time, at a 10% premium on the nominal. So 10 is a premium. This is the breakup of 117. So in second year, there will be a normal interest, which is 7, principal 100, and 10 is the premium. I hope it is clear to everyone now. Which of the following statements are correct with regard to the valuation of debt? When determining the market value of redeemable debt, the present value of future interest and redemption is calculated using coupon rate as a no. We do not use coupon rate as discount factor. We have just done the previous question. Okay, breakup of 117 is not clear again. Students in the second year, there will be an interest of 7. 100 into 7% is this. Then principal payment 100 because second year is the last year. And then examiner says premium 10% on the nominal value. Nominal value means par value. If I take 10% of 100, so premium will be 10. Oh. Okay, students, you can do one thing, please. If this addition is having problem with you, in the second year, you can separately show 7. Then again in the second year, you can show 110. But please, discount factor will remain 0.826. Because in the second year, you have to pay interest as well as redemption amount also. Now it is up to you if you are not adding them together. Is it clear now? Please reply. It is up to you if you want to keep them separately. Okay, now come here. So number 1 is false. The floor value of convertible debt equals the market value with conversion option. No. It is not with conversion option. In floor value, actually, floor value is the minimum value of the debt, and minimum value of the debt comes without the conversion option. Again, false. Floor value is the minimum value. Minimum value is instead of conversion, I'll go for redemption. Conversion premium of a convertible debt is the difference between the market value and the current conversion rate. True. Conversion value of convertible debt equals the number of shares on conversion multiply by the likely share price on the date of conversion. Of course, on the date of conversion, what happens? How many shares, one bond will be converted into how many shares, multiply by what will be the share price on that date. Simply, conversion value is equal to one bond will be converted into how many shares into the share price on that day. Student examiner has done only one thing. You people have done this sort of questions so many times numerically. Examiner has just written that numerically part in a theoretical way. Simply conversion premium we have calculated, and how do we calculate the market value of a debt in case of convertible bond, that is written in point number 4. In point number 4, examiner has just written the conversion value, which we have calculated so many times. In the last year, how do we calculate conversion value? Number of shares into the share price on that day. Anything else? The concept of floor value is only applicable when there is a convertible bond. Otherwise, the concept of floor value does not come. I think this is the last question. Students, you can see that one thing is for sure, examiner, they have tried their best to cover almost each and every area of the syllabus. Of course, we did not see business valuation there. Uh, I'll try my best to discuss the section B tomorrow. Otherwise, the day after tomorrow, definitely we are going to discuss the part B. And plus, there are a few queries on different questions. Surprisingly, I have already discussed those questions in my regular classes and practice classes as well. But I've jotted down all those questions. There are a few questions. So I'll be conducting a class on those questions as well. The shareholders return. How do we calculate shareholders return? Look at this. 2024, assuming if I'm saying start of 2024, share price is 20. End of 2024, share price is 22. Expected dividend in 24 is, let's say, that is going to be 1. And I'm asking the shareholders return. How will you calculate shareholders return? Your expected dividend is 1. Capital gain is the difference between two share prices. Share price at the end of the year, share price at the start of the year, which is 2. And you will divide this with the share price at the start of the year. The shareholders return is 15%. So student, that is all about today's class. And in today's class, the main agenda was to discuss section A of your pre-scene mock. So there were a number of students, they asked me to do that. So finally, we have done it. So inshallah, I'll try my best to discuss the section B tomorrow, otherwise the day after tomorrow. So don't worry. We will be discussing section B and then we'll go for towards section C as well. Okay, students. So hope to see you all in the next class as well. I've noted the question. Don't worry. I'll be discussing those questions in the class as well, inshallah. Okay, dear students, welcome to FM Pre-Scene Mock June 2025, section B of the pre-scene. Section A is we have already done, we have already discussed. Now it's time to discuss section B. And the first question of the section B, let's quickly discuss. First, read the requirement and then we'll go for a scenario. And normally we know that in section B, what happens? Examiner gives us a small scenario. On each, there will be 3 different scenarios. On each scenarios, there will be 5 multiple choice question. Each question worth 2 marks. Look at the first question. Why is the valuation of equity of a company necessary? Why the valuation of equity of a company is necessary? So let's read. The company is planning to raise equity finance in the primary market. Makes sense, logical. Why? Obviously, if my company wants to raise finance by issuing, let's say, shares in the capital market, so I need to know before issuing the shares, before raising the finance, I need to know equity value of my company. The company wants to establish the terms and conditions for merger and acquisition. Yes. For example, two organizations, they want to merge together. Before the merger, they should know the value of their equity. If I want to acquire a company, so before giving any offer to that company, I should value their equity. The company has the primary focus on mission driven activities, not profit motive. Basically, last one is suitable for a company which is not for a profit making organization. So that is not fitting at all. Logically, one and two out of these three, they're the reason why do we need equity value. Let's see the option. Alpha. Option one. That's great. Looks here till here it's very looks very straightforward question. Let's go ahead. Second question. That's easy, I would say. Question number two. What is the asset value of a small company? What is the asset value of a small company using? Now, this is very important. Net realizable values to the nearest thousand. Net realizable values means breakup values. Put it another way around. When examiner is asking you to calculate asset value of here small company using net realizable value. Net realizable value means breakup values. Breakup values means simply we will be selling each individual asset separately. Now try to understand. Just imagine we have closed the business and we are selling each asset individually. When I have closed the business, I'm selling each asset individually. In that way, I will never get any amount, any consideration against the goodwill. The day you will close the business, the goodwill of your business is over. When do we get actually amount, consideration against the goodwill of our company, against the goodwill of our business? When you are selling a business with valid going concern assumption. But in net realizable values, the assumption is basically where normally we use this net realizable values when going concern assumption is not valid. When going concern assumption is not valid, so how can you get even a single penny against the goodwill? So simply make it up very simple now. If your examiner says calculate asset value of company by using net realizable values, then you have to ignore goodwill. Let's apply this. Ernst company is a well-diversified company that has successfully grown over the years by adopting the strategy of inorganic growth, means buying the companies. Three acquisition opportunities have been identified. Small manufacturing company parts required for automobiles. The extract from the statement of financial position December X4 is given. Non-current assets 1275, inventory 280, receivable 520. If I add, I'll get 800. Okay. It is basically 280 plus 520 gives you 800. The non-current asset include goodwill, as we have just discussed. Net realizable values, ignore the goodwill. The other non-current assets are considered worth 80% of their book value. Book value means what is written in SOFP. So simply 1275 minus the goodwill, whatever comes, we'll take 80% of that. 1275 minus 250, let's take 80% of that, 820. Okay. The inventory is net. Read it nicely. The inventory is net and obsolescence provision of 40. This 280 is after the obsolescence provision of $40,000. Going forward, the obsolescence should be brought down to $20,000. Now listen carefully. The value of the inventory, which is written in SOFP, is 280. They have deducted the provision for obsolescence $40,000. But the question says going forward, the obsolescence provision will not be $40,000, it will be 20. So what should be done? Just adjust the value 280, add the previous provision, deduct the expected new provision. So 280 plus 40 minus 20, I'm getting 300. Wow. The receivable is expected to yield 90% of their book value. So receivable is 520. You will be getting 90% of this. So 520, 90%, 468. So simply add all of them because we have got only three assets and examiner did not ask us to go for net asset. It is categorically mentioned in the question asset values. Okay. So 820 plus 300 plus 468. Students, I'm getting 1588. Three zeros we have already ignored. It means it's 158800. Let's see where to write. It's here. Simply 1588. This is the answer. It's 1588. Zeros are outside. Okay. Next question. Actually, in section B, FM, what happens? Examiner gives us a small scenario. On that on each small scenario, examiner sets 5 questions, each worth 2 marks. 2 marks each question. What is the current value using P ratio, price earning ratio, method of the ordinary shares of medium company to the nearest 2 decimal points? Using the current value, market value, using the market value, calculate market value using P ratio. P ratio is actually equal to P naught upon earning per share. EPS is simply profit after tax divided by total ordinary shares. We know very well in financial management, so of course, while calculating earning per share, we do not go for IS 33 formula, okay? In FM, even in AFM also, EPS is calculated in a way by using a very simple formula, that is profit after tax divided by total ordinary shares. So examiner is asking us actually to calculate this P naught by using P ratio, and P ratio formula is P naught upon EPS, and we need to value, we have to calculate P naught, market value of medium company. Let's see. Medium, small we have already done. Wow, it means the last one is going to be large. Medium company is an unlisted company. Now, please, it's not a long question. It's a very short question. It's a section B question. Examiner will guide you. How will you calculate an unlisted company's current share price by using P ratio? Because we know that unlisted company does not have its P naught. So directly P naught will not be available. Examiner is going to give you the P ratio of a proxy listed company. You just need to use that. Now the question arises, sir, on a private, when it comes to a P ratio actually shows the confidence of the shareholders agreed. And obviously, on listed company, shareholders will have more confidence as compared to private company. On private companies, shareholders, they will have obviously lower confidence as compared to listed, agreed. Normally, what do we do? We actually identify similar size listed company, then we calculate P ratio for listed company, then normally we adjust that P ratio for a private company. For a long question, you have to make an assumption. Let's, for example, you are taking 70% of listed companies P ratio to utilize for private companies P ratio. Or even you can use 2/3 of the listed companies P ratio to utilize for a private company. But in a multiple choice question, Do I need to adjust the P ratio of a listed company to use for a private company? Yes or no, it will be mentioned in the question. If nothing is mentioned, whatever P ratio examiner has given you for the listed companies, you will have to use it as it is. Don't be smart in a small question, okay? In a multiple choice question and a section B question, if adjustment is required, examiner will give you the hint. Otherwise, whatever P ratio examiner gives you, and you have calculated, you will be using the same P ratio to value the listed private company. Obviously, the assumption is the P ratio of XYZ listed company is comparable for a private company as well. Medium company is an unlisted company engaged in manufacturing parts of the aerospace industry. It earns profit after tax 8 lakh 50 during the year just ended. Of course, medium company is a private company, so we need P ratio. It has 1 million ordinary shares. It means very easily I can calculate EPS of a medium sized company. Earning per share is equal to profit after tax is 8 lakh 50. Number of shares of medium company, they are 1 million. So dollar 0.85. This is EPS of medium company. Okay, a listed company engaged in the same sector has posted EPS 1.2, P ratio 10. Stop. Other than that, examiner has not given us any information. So I'll be using the same P ratio as it is for medium company. If nothing is mentioned, I'll be using the same P ratio to value the medium company. So now it becomes very easy. Simply P naught is equal to EPS into P ratio. Of course, EPS you have to take for the medium company. Earning per share of medium company is 0.85. P ratio of a listed company I'll take 10, which is the background assumption is the P ratio of this listed company is exactly comparable with medium company. So P naught becomes 8.5. So P naught becomes 8.5. Let's see. 8.5. So simply to the nearest two decimal places, 8.5, or you can make it 8.50. Let's go ahead. What is the next requirement? Which of the following correctly represents the value of alpha startup using discounted cash flow basis? Now listen carefully, students. Whenever I need to value the business on discounted cash flow basis, don't forget one thing. What is that? Let me explain. Basically, whenever we need to value the business on the basis of discounted cash flows, so examiner will give you obviously the cash flows plus after maybe 2 years, 3 years, 4 years, examiner will give you the growth rate. And you actually, when I'm going to calculate value for business on the basis of discounted cash flows, so I need to calculate the present value of discounted cash flows till infinity. Sum of present value of the cash flows till infinity, that is your business value. Alpha startup is engaged in a software development. Its new software is fast becoming popular and market seems to be promising. The cash flow projection for the coming years are given below. Year 1, 2, 3, 4. Post year 4, the cash flows are expected to rise by 2% perpetuity, 2% forever. Every year it will keep increasing 2%. But the growth rate is applicable after year 4, means from T5 till T infinity. The cost of capital is 11%. Now listen, logically from year 5 onwards, the cash flows will increase by 2%. From year 5 onwards, your cash flows, they will increase by 2% forever. So simply, how will you, which formula you will be using from year 5 till infinity? It's very simple. if you just recall dividend valuation formula, P naught is equal to D naught 1 plus G upon K minus G. Okay. Now simply this formula will be replaced. Instead of K, I'll use back weighted average cost of capital, number one. Number two, whenever I need to use this formula, like here, after year 5 till infinity. So what are you going to do? How will you calculate the present value? So let's do it here. 1, 2, 3, 4, 5 till infinity. Cash flows is 130, 180, 210, 240. I'll take 240 into 1.02. WACC is 11% minus 0.02. Now, at 11% discount rate, let me use a calculator. For the first year, of course, solving this on Excel is far more easier. 0.90. Here I'm getting 0.8. 16. 0.731. 0.5 or 659. Now, we are utilizing the formula from year 5 till infinity. So whatever the answer comes of 240 into 1.02 divided by 0.11 minus 0.02, that will be discounted by the previous year discount factor, 659. For example, if you were using this formula from year 3 onwards, so you will be using the discount factor of the second year. Always use the discount factor of the base year. Base year means previous year. Simply multiply by the discount factor of base year. Base year means previous year. Okay. In our regular classes, we have used this a lot. So this should not be a problem at all. So 130.9, 117, 180, 8116, 146, 210.731. I'm getting 153.5, 240 into 0.659. Okay, 158.16. Now first, please try to solve this. Actually, it is 240 multiplied by 1.02. I'm getting 244.8. In the denominator, you will get 0.09. So 244.8 divided by 0.09. I'm getting logically, answer of this is 2720. Logically, 2720 will be multiplied by 0.5 or 0.659. So 2720 multiplied by 0.659. I'm getting 1792.48. 240 into 1.02 gives us 244.8. In the denominator, we have got WACC 0.11 minus 0.02 will get 0.09. So the answer is 2720 multiplied by the base year discount factor. Now simply add all of them, you will get business value. 117 plus 146 plus 153.5 plus 158.16 plus 1792.48. I'm getting 2367.14 and we have ignored 3 zeros. Okay, don't forget that. We have ignored 3 zeros. So if you don't get exact answers, so go to the nearest choice, delta. Delta is the nearest choice. Okay, let's see. Next question. Which of the following is the correct way to calculate market capitalization of a listed company? Which of the following is the correct way to calculate market cap? How do we calculate market capitalization of a listed company? It's very simple. Market capitalization. Issued shares multiplied by P naught, current share price. You're a listed company. You have your current market share price. Issued shares multiplied by the current price. Number of ordinary shares in issue multiplied by the current market price per share. Perfect, perfect. Let's read others as well. Weighted average number of ordinary shares. No, 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 no. Number of ordinary shares in issued by multiply by the average market. No, not average. Just take the current market value. Number of ordinary shares in issued multiply by the current market price per share plus the market. Oh, actually, in market capitalization, only equity is considered, not debt. In other words, logically, the market capitalization is your market value equity. So why the last one is incorrect? Because when I'm calculating market capitalization, logically I'm calculating market value equity. So how can I take debt? That's why the choice number 4 is incorrect. Choice number 3 is absolutely incorrect. Don't go for average market price. We just use current market price. And similarly, we don't take weighted average number of ordinary shares. We take all the ordinary shares which company has already issued. So that is why option 1 is the right answer. So students, that was all about section B, first question. I hope you have enjoyed this question. Don't worry at all. We'll be keep posting other lectures, other questions, videos as well. So hope to see you all in the next class as well. Thank you very much. Okay, students, let's discuss another question of section B. And this scenario covers question from 21 to 25. Let's read the first question and then the scenario. Considering the opinion of junior accountant, classify each of the following statements as true or false. The interest rate parity states that forward exchange rate is based on the spot rate, yes, and the interest rate differential between two countries, true. Obviously, in interest rate parity, what do we do? How do we calculate forward rate? We take the spot rate and we take interest differential between two countries. The job is done. Mac George company will receive more dollars if euro will depreciate in 4 months' time against the dollar. Basically, for this, number one, we have to read the scenario that which currency is local and which is foreign currency. But let me tell you one very basic concept. In case of export, means in case of receipts, if your currency is getting weaker, in case of receipts, if your company is getting weaker, so you will get the gain. Repeat, if there is an export, receipts are coming in foreign exchange, your home currency, your local currency is getting depreciated, then you are going to have exchange gain. Okay. And if there are receipts, you're going to get amount in the foreign currency and your local currency, domestic currency is getting stronger, strengthened. Then in case of export, you will be having exchange loss. Obviously, when my currency is getting stronger, when I'm going to convert foreign currency into my local currency, I'll get the less amount. If my currency getting weaker, okay, in case of receipts, when I'm going to receive a foreign exchange in the future, when I'll convert that into my local currency, so amount will increase. And the same concept in an opposite direction applies on import. So let's read the scenario. Because without knowing which currency is local, which is foreign, we cannot decide. Second statement. Mac George company is based out of a country of Zealand whose currency is dollars. Mac George, local currency is dollars. The company has supplied goods to customer in a country of Euro base in Europe, having currency euro. So your currency is dollars, home currency. Foreign currency is euro. Okay, now it's very simple. Your local currency is dollars, okay? And foreign currency is euro. Mac George is due to receive 2.1 million in 4 months' time. Now come here. Mac George company will receive more dollar if euro will be depreciate. Actually, number one is a scenario of receipts. There's an export. And logically, if foreign currency is depreciating, it means local currency appreciates. Local currency becoming stronger, strengthened. As we have already discussed, in case of export, if your local currency becomes stronger, strengthened day by day, then on export you will be having exchange loss rather than gain. So you will not be getting more dollars, you will be getting less dollars because your dollar is coming stronger against the euro. So obviously, when my dollar is coming stronger against the euro, when I'm going to convert euros into dollar in the future, I'll get less dollars. So second one is false. Which of the following risk would Mac George company face regarding the receipts? Obviously, transaction risk. Transaction risk is a short-term risk which you face when there are payments or receipts within 12 months' time in foreign exchange. Transaction risk. Wow. So far, looks pretty straightforward question. Let's see. What will be the 4 months exchange rate between the euro and dollar, assuming that interest rate parity holds? Good. It's very simple. We need 4 months forward rate. Let's take the spot rate. The current spot rate is euro per dollar. Students, euro is in numerator. So the interest rate of euro will be in the numerator and dollar is in the denominator. Interest rate of the dollar will be in the denominator. So it is euro 1.3985 per dollar one. So, okay, this is the scenario. We need to convert this spot rate into 4 months forward rate. Simply multiply this with interest rate of euro comes in the numerator, interest rate of dollar comes in the denominator. It's very simple. Obviously, either you are writing one or not, it makes no difference. Zealand and Euro are 1.9% per annum. Okay, the short-term interest rates in Zealand. Mac George is based out in the country of Zealand. 1.90. So basically 1.90% is representing the dollars. 3.75% is representing the euros. But these rates are per annum. We have to convert them into 4 months. So it's very simple. 1.90, 4 by 12. Let's see what I'm getting. 1.9, 4 by 12. Actually, I'm getting 0.6333%. 3.75 into 4 by 12, I'm getting 1.25%. So it will become 1.00633 euro is here. This is representing euro. 3.75, dollar is 1.9. So 1.0125 divided by 1.00633. So let's see what we are getting. 1 point. So now do simply multiply this 1.3985 with 1.0125 divided by 1.00633. Students, logically I'm getting euro 1.40707 upon dollar one. Let's see the nearest one. 1.4070 this. So beta is the nearest one. If you don't get the exact answer, so obviously go for the nearest one. So simply we have used the interest rate parity, nothing else. Till here looks pretty straightforward. Okay. Which of the following hedging tool will be useful for George company to hedge against the possible interest rate risk and 2.1 million euro receipts? So actually there are two hedges. They want to hedge interest rate risk as well as 2.1 million receipts. For interest rate risk, we have to read the scenario. Which risk they are facing? Are they facing a risk of a rise in the interest rate, or they are facing the risk of decrease in the interest rate? Because in both the cases, hedging instruments, hedging techniques are different. Receipts, we know that 2.1 million, but we don't know about the interest rate. McGeorge is considering raising funds to part finance his new project by obtaining a debt from a well-known bank at a variable interest rate. In 3 months' time, for 12 months, the bank quoted the interest rate of base rate plus 0.5%. The company is, however, worried that base rate may go up. The finance director wants to hedge this risk. First of all, you should know when it comes to interest rate, they want to borrow. Let me minimize this. When it comes to interest rate, they want to borrow. Okay. So here the company is a borrower when it comes to the interest rate. Let's see. We have to hedge two risks. One is interest rate, and keep one thing in your mind, interest rate, they are the borrower, okay, for interest rate. And borrower faces the risk that interest rate might rise. Buy a forward rate agreement. If you buy a forward rate agreement, simply interest rate becomes fixed for you. And sell euro at forward rate. That's perfect. Number one is absolutely correct. Obviously, 2.1 million receipts can easily be hedged by selling at forward rate. Just take the forward rate to sell euro 2.1 million and just buy a forward rate agreement for interest rate risk. When you're going to buy a forward rate agreement, that will make interest rate fixed for you. Okay, now another point is sell a forward rate agreement. No, we don't sell. Bank is the one which sells the forward rate agreement, not the counterparty. So that is why the two is absolutely incorrect. Plus, to in order to hedge the receipts in euro, we don't buy forward in euro, we sell. So point number two is incorrect. Buy interest rate futures. Buy interest rate futures, wrong. Basically, when it comes to borrower does not buy interest rate future. Borrower actually they sell interest rate future. The hedging strategy for the borrower in case of interest rate future is sell now, buy later. So borrower actually they actually sell interest rate future rather than buy. So they sell interest rate future rather than buy. So again, incorrect. Buy interest rate call, a borrower basically buys put option. So basically only first one is the correct answer. Okay. Well, so far it looks easy. So far, I don't know what is coming next. Assuming that the expected exchange rate is euro 1.4070 per dollar one in 4 months' time. Okay. Calculate gain or loss for McGeorge company if it had hedged the receipt 2.1 million today using forward rate 1.3995. So forward rate is euro 1.3995. Okay. Actually, we need to check either due to hedging, there's a gain or loss. Now listen, due to hedging, the forward rate which Mac George got is 1.3995. If there wasn't any hedging, so expected exchange rate on that day without hedging is 1.4070. Number one, first of all, you should know that your local currency is dollar and exchange rates which is given to you, that is an indirect code. In case of indirect code, we actually divide in order to translate. Now listen, receipt amount is 2.1 million euro. So simply euro 2.1 million. Let's see due to hedging how many dollars they have received. 2.1 million divided by 1.3995. So they have received 1,500,536 dollars. If there wasn't any hedging, then applicable exchange rate is 1.4070. Let's see how many dollars without hedge. Without hedge, 1.4070. Without hedge, they could have got dollars 1492537. So it can be seen that due to hedging, there's an exchange gain. Hedging, actually, it has resulted in a gain because the receipts in dollar, they are more as compared to without hedge. Let's see the difference. Gain because of hedging. Gain, so 1500536 1492537. The gain amount is $7,999. Logically, there's a gain. 7,999. So far looks easier. Now, what comes next? We don't know. Wow, 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 wow. The question has ended, and I would say a pretty straightforward question. A very basic understanding of, I would say, interest rate hedges plus transaction risk. To be very honest, all those students, they have seen my regular lectures. They could have done this very easily. No problem at all. So I hope you like this question, and I hope that you're going to have a more or less similar question in exam. If this is going to be the level of difficulty, so getting 10 out of 10 in such a question is very, very easy. So thank you very much. Okay, students, let's quickly discuss the last question of section B. Calculate the accounts receivable collection period for the green company from the table above. Days to the nearest days. Okay. Simply we have been given receivable for 50 sales. Obviously, I need credit sale. Nothing is mentioned that entire sale is credit sale. But when it categorically, specifically, examiner has mentioned the 75% of the sale is credit. So I'll be taking 75% of the sales. So receivable, just receivable days, debtor days, make it easy, is equal to. The amount of the receivable is 450 divided by the credit sales. Nothing is mentioned that entire sale is credit sale, but here examiner has specifically mentioned 75%. So we'll take 75% of this, which is coming 1125. Take 365 given in the question. So 450 divided by 1125, a pretty straightforward, I would say, question. I like it. 146 days. Wow, 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 wow. Straightforward. No issue at all. Just the formula, write the formula, get the answer. I like it. What is the Payable payment period for green company based on the table above. Just payables payment period is equal to, I need the amount of payable, which is trade payable. They have given us 180. Now, logically, I should be dividing this 180 with the total credit purchases. Logically, we should divide this 180. Accounts payable, trade payables should be ideally divided by the total credit purchases. But if examiner does not give us the credit purchases, then we go for cost of sale. But here examiner is very nice towards you. Total purchases are 1200. Out of that, 60% they are your credit purchases. So no need to go for cost of sale. Just take 60% of this. I love it. I love it. Seriously. I love here examiner is very nice towards you. Just multiply this with 365. So 180 divided by 720 into 365. I'm getting 91.25 days. Obviously, choose the option 91. Great. So far, easy question. But let's see what happens, what comes next. Which of the following statements are attributable to JIT inventory management? JIT, just in stock management. Let's see. JIT aims to make a production process flexible by making it responsive to customers' requirement. Yes. Logically, we say that there shouldn't be any production for the sake of warehousing in case of JIT. Normally, in case of JIT, we do production, we do purchases when readily demand is available. So in JIT, the aim is to make production process flexible by making responsive to customers' requirement. Okay. The main aim of JIT is to calculate optimum order quantity to be ordered. Oh no. We are not talking about EOQ. The system aims to reduce capital tie. Yes, I don't want to tie up so much capital into the inventory. What is the biggest benefit of JIT is I don't want to tie up so much capital into the inventory. A JIT manufacturer looks for a single supplier who can provide lowest price rather than high quality. No. Frequent and reliable deliveries. There's something correct, something wrong. A, a JIT manufacturer looks for a single supplier, makes sense. Actually, who can provide high quality products, frequent and reliable deliveries, low prices, you have written wrong. Now listen, when I'm going to rely on a supplier, okay, who is going to give me a good high quality, I need a high quality products, not low quality. High quality. Now listen, when I'm going to technically JIT is not possible without relying on a supplier, without having a reliable supplier. Number one. Now, someone actually is basically supporting my JIT system. So please don't expect to get the raw material from that supplier at a cheaper price. Number one. Number two, I'm not after a low quality product. I need a high quality. So little bit correct, little bit wrong. So fourth is incorrect simply. So logically 1 and 3. Let's see. Do we have that option? Yes. So far question looks easier. Let's see. What comes next? What comes next? Whoa. What is this? EOQ. What will be EOQ? Economic order quantity. Students. 2DC naught upon CH. 2D is the annual demand. C naught is per order cost. CH is per unit holding cost. Make sure when it comes to per unit holding cost, if examiner gives you any hint of any information of cost of capital, then that all increases your holding cost. The monthly requirement of one of material is 5,000 units. Then multiply by 12 gives you the annual requirement, which is 60,000. Economic order quantity. 2D into The purchase price is 12 per unit, irrelevant right now. Green company's cost of capital is 10% per year. So you are bearing the cost. Examiner has given you the information. 10% cost of capital. Okay. The storage cost per unit is 1.75. The storage cost per unit is 1.75. The vendor charges 175 per order for each delivery. So your ordering cost is 175. Now listen carefully. When it comes to basically your holding cost, now here your holding cost is not only 1.75. Your holding cost is not only 1.75. Basically, your holding cost is not only 1.75 because examiner has given you the cost of capital, 10%. So logically, your per unit holding cost is 1.75 plus. This is the storage cost, plus you are bearing other cost as well. So that is your financing cost. 10% of that purchase price. Because if there wasn't any cost of capital, nothing else, I would have taken only 1.75. So logically, my holding cost is not only 1.75, I'm bearing other cost as well. I'm bearing the financing cost as well. So 12 into this. So now your holding cost is actually 2.95. Square root means just take the power 1 upon 2. 1 upon 2 means take the power 0.5. So let's use a calculator. 2 multiplied by 60,000 multiplied by 175, then divided by 2.95. Then take power 0.5. I'm getting 2668 units. 2,600 and wow. 2,668 units. So far, it's easy. Let's see what comes next. Assuming 360 days in a year, what is the annual effective cost of the? I love such question. I love it. Seriously. I deeply love such questions where maths is involved. Okay. I love that. Assuming 360 days in a year. Okay. What is the annual effective rate of the discount to one decimal place of a percentage? Annual effective rate. Annual effective rate of the discount is equal to, how will you calculate this? It's very simple. 1 plus take the discount amount. Divide by net amount. Net amount means after discount. Then just take number of days which examiner has given, divided by, I'll tell you, divided by what? -1. Then whatever comes multiply by the percentage. We are calculating effective cost of the discount. Green company is conceding to offer a cash discount of 1.5%. Now listen, assuming you are about to receive $100, you are giving a discount of 1.5. So it means your net amount after discount will be 98.5. 100, we just assume, okay? So we are offering discount of 1.5% to a specified segment of customers. So number one, your discount is 1.5. After discount, you'll be getting 98.5. Okay. 360 remains there. To a specified segment of customer, pay if they pay within 60 days. So I need to know how many days they were taking before this. To get the discount, they will be making payment in 60 days. Currently, they pay within 90 days. Now, listen, those they were paying in 90 days, now they are going to pay in 60 days. How many days earlier they will be paying? 30 days. Repeat, those they were paying in 90 days. Now they'll be paying you in 60 days. So how many days earlier they will be paying you? 30 days. So basically what comes in the denominator, just check how many days your customers were taking before the discount and how many days they will take in order to get the discount, difference, reduction in the days. So 360 divided by reduction in the days minus 1. Now let's use the calculator. 1.5 divided by 98.5 plus 1. Within the bracket, I'm getting 1.015228426. Okay. Logically, 360 divided by 30. That gives you 12 minus 1. So 1.015228426 power 12 minus 1 into 100. I'm getting 19.885%. I'm getting 19.885%. Let's see. They're asking us to one decimal. Let's see. One decimal. So which one is correct? To one decimal place of a percentage. So 19.885, make it 19.89%. So your annual effective cost, if you want to provide a discount of 1.5%, then annually your cost is actually 19.89%. 1 plus discount divided by net amount 360. Then in the denominator, you have to just check. Earlier, your customer was taking how many days in order to get the discount, in how many days they have to pay difference. So 360 divided by that difference. The rest is the formula will do it. That is your annual effective cost of providing the discount. Now, logically, when we provide discount, we get amount earlier, but always remember cash discount is a cost. So this is the cost. Obviously, company will have to check, will it be financially beneficial for them to do or not? But that is not the question here. So still here is perfect, easy. I would say, student, one of the easiest question in the pre-scene mock. In fact, in pre-scene mock, section A was very easy, and section B, I would say, is easier than section A. So that is all about your section B of pre-scene mock. If you have any other queries in any of the mock, you can always ask in your relevant WhatsApp group if you are an enrolled students. And let me tell you, there are plenty of practice videos they are uploaded on my portal. Plus another good thing is my lectures are not very long at all, because if the lecture goes longer, student they lose interest. That is why me and my entire team, we try our best that a good quality lecture should be delivered in a very limited period of time. So I try my best to teach you each and everything in a very short period of time. And highest record in FM, one of my students took world top, marks are 94. And in AFM, Alhamdulillah, we have also produced the world top. In ATX, the highest marks are 95. In taxation, one of my students got 99 marks. In FR, the highest marks are 92. In SBR, the highest marks are 85. Let's see who is going to break the record in this attempt. So thank you very much. Hope to see you all in other papers as well. Thank you.